What is going on, you guys? Welcome back to another video. If you're new here to the channel, my name is Brandon. We post a video on investing in the stock market every week. So make sure you hit that subscribe button and don't forget to hit the bell for notifications. And if you're looking to learn a little bit more about investing, you can actually check out our Investing Academy. It's that first link down in the description below. But in today's video, I wanted to address a comment that actually came in a week or so ago. And for some reason, I was having a bit of trouble locating the exact comment, but it went something like this. The lady asked whether it was too late for her to start investing. She had never invested before. She noticed that a lot of the videos on the channel are kind of targeted towards younger investors, for millennials, which the channel kind of is. But she said, I'm 55 years old. I've never invested before in my life. Is it even worth it to go out and start investing? Now, my personal answer to that, personally, is 100% yes. I would say if you have the option of just letting your money sit in cash, whether it's just for a 10-year period, for a shorter amount of time than a younger person who has decades and decades to invest, if you have the option of letting that money sit in cash where there's no opportunity for growth, and actually if you want to get technical about it, if the money's just sitting in cash, you're actually losing 2 to 3% per year when you factor in inflation. When the cost of goods are rising, your purchasing power is actually decreasing if you decide to just leave that in cash. So my suggestion for somebody like that is, at a minimum, what we want to do is try to upkeep with inflation at a minimum, and we can actually probably do much better than that. You know, without getting into too much detail here, guys, we have clients that come into our firm that are 70 years old, that are 80 years old, that have significant chunks of money, and they're ready to invest that. Because keep in mind, guys, that, you know, on YouTube and on the news, everyone talks about stocks, the stock market, and equities. There are still a wide variety of other investment options out there for you to go out and buy. Take the fixed income market, for example. You could go out and invest in a bond, or a GIC, or a term deposit, or a treasury bill, where you're basically locking in an interest rate. You know, it's not going to be growing as much as the equity market, that's for sure. But at the same time, if at a minimum you can keep up with inflation and keep your purchasing power, to me, that in and of itself is a no-brainer. Now, I had a point that I wanted to actually mention here that a lot of people tend to overlook. And that is that for many people that find themselves in that older age range, older relative to me, but let's call it your 50s, 55, 60s. Let's say, let's use this exact example of the lady who's 55 years old. She may very well think that she has a 10-year period, a 10-year horizon to invest her funds. That's why she's asking, is it even worth it or not? She plans to work from 55 to 65, then retire, stop working, etc. Go relax. Now, I tell her that that's actually probably not correct. She doesn't have a 10-year time horizon or time period, because actually most people, once they retire, they continue investing. All right, it's very uncommon that when you hit age 65 that you're just gonna wipe out and just liquidate your portfolio. It really wouldn't make a whole bunch of sense that the day you stop working, you just decide to take out all your investments and hold that money in cash. What's much more common is that you invest into your retirement. So let's call that hopefully another 10, 15, 20 years plus. So that in and of itself, from a 55-year-old, actually stretches your time horizon from 10 years to 20 years plus, which that actually makes a big difference, right? That's what I'd consider a long-term time horizon. Now, granted, of course, the types of investments would probably be shifting, especially once you stop working and you no longer have income coming in. You're probably going to put a very high emphasis on these income-bearing or interest-bearing investments, like I mentioned, bonds, GICs, term deposits, because that's ultimately what you're going to be living off of. Dividend stocks is another one that I didn't mention there, but of course, that's another very viable option. Now, of course, if you find yourself in this situation and you're deciding whether to invest or not, my suggestion to you guys would be that you have to come in with a properly structured plan. You have to come in with a proper strategy, because you're at a point where there's a lot more on the line than a 20-year-old who's working a summer job and just has a little bit of extra cash laying around. For somebody that's 55, 60, you have to come in with a properly balanced portfolio. And what I'm talking about here is your asset allocation. That's really the first main target that you have to decide. Your portfolio balance is going to look very different than the balance of a 20-year-old's portfolio. The 20-year-old may be striving for growth and say, listen, I want to invest all in equities. I want to go out and pick a bunch of stocks, maybe hold a little bit of bonds. Well, somebody who's a little bit older, it would actually have to be kind of the opposite of that. Maybe your portfolio would be predominantly built up of fixed income, where historically they've performed quite well even during a market downturn. And for the most part, they're just going to be trucking along, and you're just going to be pulling in that income or that interest income, which does provide a relatively safe form of investment. That said, even for somebody that's a bit older, I would still say, hey, go out and invest in the stock market. Take a portion of your portfolio, whether that be 30%, whether that be 40%, whether that be as high as 50%, right? Take half the portfolio and you can go out and invest in the stock market. Let me show you actually a chart here that I found here. This is just a random mutual fund that I found just looking on Fidelity's page, okay? This is just like literally a random one that I just pulled up. And it's called the Fidelity Canadian Asset Allocation Fund, which is kind of exactly what we're talking about. We'll come revisit this chart in just a second here, but this is what I consider very much a balanced fund. As you kind of look down to the actual breakdown here, the actual allocation, you see that about 50% of the fund is invested in Canadian stocks or Canadian equities. So half of your portfolio is invested into the Canadian market. You have a bit of exposure here to foreign equities. It looks like a pretty small component, 13% of the portfolio. And the remainder is invested here in bonds. We see Canadian bonds, we see foreign bonds making up about 30 to 40% of a portfolio. That's what we'd consider a balanced portfolio. And that's what I mean when I say, you know, if you want to go out and tackle investing, you don't just want to go out and pick a bunch of random stocks. You don't want to go out and invest in Amazon, AMD, Nvidia, pick all these aggressive stocks for somebody that age, which may be suitable for a younger person. Take the approach of coming in with a balanced portfolio like this, guys. This portfolio, since inception, since this fund was started, has returned an average of 7.58%. And again, just to revisit this chart here, guys, you know, everybody's so worried about that big crash that's going to be coming, 10 years into the bull run, it's got to be here. Well, look how this fund performed during 2008 and 2009, right? We see a couple years of poor performance, and keep in mind, this was one of the worst recessions that we've seen, really, the worst recession since the Great Depression. This was a massive downturn, but within a short matter of years here, like what's this looking like, a couple years, maybe 3 years, your fund has already broken even and you're up pushing to higher highs. Because of that balance between equities and fixed income, in this case 40%, about half the portfolio invested in safe assets, the recovery is not all that bad. I mean, taking a look at that, that's 2 years till it's broken those previous highs. Not to mention that if you are dollar cost averaging, so if you're adding money to your portfolio every month or every quarter, you're actually going to break even a lot faster than this. So it's impossible to say what's going to happen over the next 10 years. No one knows. It's great to look back at the history and try and get some ideas, try to get a realistic expectation of what type of returns we can expect over the next 10, 15 years. I'd like to think that, especially if you're investing on a monthly basis, you're going to come out net positive, especially when you have a good chunk of your portfolio, a good chunk of your investments in these safe interest-bearing investments, which you're just pretty much drawing in income along the way. That said, this is just a mutual fund that I literally pulled up, like without even doing any research into it. I just picked an example of a balanced portfolio. You could always opt to go more conservative this. Maybe go for a 30-60 portfolio, meaning that only 30% of your investments are invested in the stock market, 60% is invested in fixed income. And if you do go out to pick individual stocks yourself, go for more of the conservative stocks. Go for some nice quality dividend stocks like Walmart's, Procter & Gamble's, rather than going out and chasing a bunch of tech stocks. There are many ways that you can invest when you're older. And in my opinion, if you have the option of letting that money sit in cash or putting that money at work for you, to me, it's an absolute no-brainer. Just understand that you have to be following a suitable strategy for somebody your age. Don't get me wrong, it's not like, obviously the earlier you get started, the better. That's why I love promoting investing amongst people my age, because all you have to do is just get started, and compound interest is going to do so well for you. It's going to do wonders for you. But even if you're 55, 50, and you're thinking, should I start? Let's say you even want to go a little more conservative than this fund if you choose. Sure, maybe you won't be compounding your growth at 7 to 8%, but let's target a 5% rate of return, maybe even 4. That in and of itself is outpacing inflation. And if you can grow your wealth, give you a little bit more money for retirement, maybe you can like pass some of that money down to your grandkids. Maybe it's money that you can help for schooling for your children one day, or whatever the case is. In my opinion, you're leaving money on the table if you decide not to invest, even if you're older and you've never invested before. You have to be coming in with the right approach. You have to be coming in conservatively relative to a 20-year-old who's starting out. But absolutely, there's an opportunity to invest, even for somebody who's never invested before. They think that it's too late. Like I said, your time horizon is probably longer than you expect. Even if we were to see a crash, if your portfolio is structured in a way that you're not overexposed to the markets, you can do just fine, and at a minimum, try to outpace inflation so that you're not losing your purchasing power. Many ways to do it there, guys, but those were just my thoughts on whether it's too late for somebody that's older to invest. But that'll wrap it up for the video. I'd love to hear your thoughts and comments on this topic down in the comment section below. If you enjoyed hearing my thoughts, and again, guys, these are just my thoughts, okay? Keep that in mind. Feel free to give this video a thumbs up and subscribe if you're not already subscribed. Like I said, go check out our membership group and our course. You can go sign up for some discounts. Is that first link down in the description below. But as always, I thank you guys for watching. I hope you enjoyed, and I'll see you in the next video.